time permits, I'll incorporate them into the panel. Okay, so on to the first question. As I'm sure we're all aware, the broader energy industry is undergoing a significant demand shock due to the containment measures implemented to combat COVID-19. I think most that are dialing in today are familiar with the Precision story. So as I turn it over to Kevin and Carrie, I'm hoping that the two of you could kick things off with a more general update on the North American contract drilling landscape and how Precision has responded from an operational perspective. Over to you guys.
Good. Thank you, Aaron. Appreciate everyone joining us today. So let me begin by saying that certainly the months of March, April, and May were the deepest, sharpest, most challenging time I've seen in my career, which dates back to mid-1982. The veracity of the slowdown, driven by both the COVID-19 pandemic and the OPEC oil price war, led to essentially every customer conversation we had during that 3-month period was tied to reducing activity, reducing costs, slowing down rigs, where possible, releasing those rigs. But it's clear that that work seems to be largely behind our customers now. In fact, we've noticed a change in tone really beginning in June, where now most of our conversations with our customers are refocusing back on, for lack of a better term, kind of normal operating mode. Our conversations are generally about operating efficiency, about performance, about safety, quite a few discussions about technology and alpha analytics and alpha automation. And good progress on those fronts, which I'm sure we'll speak to in a few minutes. But we'll tell you that we are yet to see much visibility emerging for the back half of this year. We do have a clear line on a modest summer improvement in Canada. Currently, we're running, I think, 10 rigs today in Canada, and we expect to see that climb up seasonally to 20 rigs sometime in late July, and then possibly into the mid to high 20s later in the third quarter, and possibly getting into the 30s in Q4. So that's a huge improvement from the lows of Q2, but still making for the weakest year of Canadian activity we've dealt with in our history as an industry and as a company. Precision's market share in Canada remains quite strong in the 40 to 50% range. And that's primarily because most of the current activity that we're seeing is Montney, Duvernay-related plays where our fleet of Canadian AC Super Triples has a strong market position, and as such, we're enjoying strong market share as that business picks up for the summer. In the U.S., I think we're running 22 or 23 rigs today. We have a line of sight visibility to a handful of additional rigs to be added during the third quarter. This is not a rebound. It is just simply kind of a balancing out on the bottom. So current activity in the low 20s. We have another dozen rigs which are under contract, being paid for, but not running right now. We see opportunities to activate anywhere from 2 to 4, maybe 5 rigs over the coming weeks in the U.S., primarily focused on Haynesville and Marcellus gas, but potentially 1 or 2 rigs in Permian and oil, likely on sort of drill to hold lease opportunities. We've taken a number of steps, both with our fixed costs and our G&A costs to reduce costs. I'll let Carrie speak to that in a moment. But I'll tell you that our priorities for the year remain maximizing our free cash flow and prioritizing that free cash flow to liquidity to ensure we have adequate liquidity for the downturn. Number 2, ensuring that our rigs remain operationally excellent. And number 3, continuing to fully develop our technology offerings, which we've seen good progress this year. We'll report in more detail on our Q2 conference call in July, but we can give some color on how that's going during this call. Carrie, if you can just update our listeners on free cash flow initiatives and our debt plans, that'd be good. Thank you.
Sure, Kevin. So I'll go back to the end of March. We had a press release where we highlighted both the steps the company was taking to protect our workers, but also the steps that we were taking to reduce our cost and to preserve cash, given the unique circumstances we had found ourselves in. At first, we announced a number of initiatives to reduce cash expenditures by over $100 million in 2020. That would include a 30% reduction in fixed cost and a $30 million reduction in G&A, which would be included in that $100 million reduction. Some of the steps on that fixed cost reduction included board and executive salary reductions, headcount reductions, really clamping down on non-essential expenditures, travel and entertainment. And all of those we think will produce, or already producing benefits. The decisions have already been made, and the processes have been implemented to achieve those savings. So we're seeing the benefits right now. We also had a 50% reduction in our capital expenditures for the year, going from 95 million to 48 million for the year is what we estimate. And beyond those cost savings, we also negotiated covenant amendment relief with our senior lending group, and that'll give us relief on one main covenant, an EBITDA to interest covenant, all the way through the first quarter of 2022. So all of these initiatives were really focused around getting our cost structure in line with what we expect to be reduced activity in 2020 and maybe into 2021, and to preserve the strong liquidity position that we enjoyed entering 2020. So how that plays out, we've at the end of March we had about 100 million of cash on the balance sheet. We had nothing drawn on our $500 million U.S. Revolving credit facility, and no material maturities due on our high yield notes until December of 2023. We have a stub maturity in December of next year, which is about $65 million U.S. as of our last conference call, and we think we'll be in a really good position to pay that and still have a good liquidity position exiting next year. So I'll stop there and hand it back over to Kevin, unless, Kevin, you think there's anything else you want me to elaborate on?
No, let's go back to Aaron, and Aaron, ask if you have any questions.
Yeah, sure. Over the last couple of years, it appeared like the broader energy sector was transitioning from a growth-oriented sector to more of a mature sector that was focused on returns and overall profitability. Obviously, profitability is challenged in the near term, but do you think that COVID has accelerated or delayed this transition for the broader energy industry, and what will Precision focus on as industry fundamentals recover?
Aaron, there's no question that the slowdown driven by both COVID and the resulting reduction in oil demand has really put a focus on free cash flow, profitability, all the core investor metrics that I think the industry has been focused on for a couple of years now. But certainly in the current environment, growth is not possible. Maybe you can get some growth at the margin with technology, maybe you can get some recovery, but growth in this environment as a theme will not exist as a theme by itself. So for sure, I think our sector is looking to attract investors by showing very strict capital discipline, very strict financial discipline, finding ways to be cash flow positive and eventually earnings positive. I think those are all themes that will resonate throughout both the E&P industry and the services industry. But I really think in the short term, the bigger discussion is around survival, in which companies are positioned to survive, since the length of this period of low demand is really yet indeterminate. And I think that's where most focus is. Hence Kerry's comments on us really zeroing in the near term on cash liquidity and looking kind of longer term at our maturities and dealing with debt. So I'm not sure if I'm answering your question completely, Aaron, but I tell you that's where I think the focus is for Precision for sure. But industry as a whole, no question that the themes of free cash flow and transitioning back to positive EPS is important for all companies. Certainly for Precision, we see that. I think we are likely on path to be EPS positive for the balance of 2020 prior to the COVID crisis. And I would see that even in a modest rebounding environment, and that's probably something like WTI 48 to 55, we can move ourselves back into a positive EPS scenario quite quickly, especially with the changes we've made in our fixed cost base and our G&A base.
I'm going to ask you about technology initiatives separately, but It's a well-documented phenomenon that downturns result in equipment attrition or a shrinking of the supply of drilling rigs in this case, as legacy assets are decommissioned. Are you beginning to see this play out, or is it too early? And how do you see the competitive landscape changing over the next few years?
Yeah, Aaron, I think it's still early. You know, we all have to remember that while it feels like a long time we've been isolated or at home or in lockdowns, it feels like a long time. It's really, you know, just a matter of a few weeks, not even a few quarters yet. You know, we're just one full quarter into this lockdown and reduction in demand. So I think it's from a capital asset standpoint, it's still a little bit early for mass retirements. Now you have to realize that a number of our components have time-based recertifications in that if the rigs haven't been used for 2 or 3 or 4 years, some of the components like BOPs actually just time out. And certainly in a market like this where the rates are going to be lower and demand is low, it just does not make sense to recertify that equipment on really expensive recertifications if there's still no prospect for work. So I think that some equipment will time out and be retired. Certainly lower performing assets that had low utilization over the past few years are at risk. This is evident in the well service business where the rig counts and well servicing have dropped. CAODC registrations are down, I think 40% in well service rigs. You're seeing a similar phenomenon in drilling rigs where I think the CAODC registered list has dropped by a couple of hundred rigs over the past several years. But you have to remember that a block of those also moved to the U.S. But I do think looking forward over the next several quarters, you'll see more rigs drop off that don't get recertified. You'll see more rigs move to auction. You'll see companies that are in financial distress. There may be, maybe rig auctions that essentially take the equipment out of circulation. So I do think the fleet will shrink. I think that if the CAODC fleet today has 500 rigs, a year from now it could be something like 75% of that or less.
Okay, and I promised I'd ask you about technology. So it's obviously been a focus for Precision over the past few years. Are these initiatives still progressing, or have they paused due to a focus on maintaining liquidity and a lack of opportunities given how low activity levels are? And are there any recent milestones that you've achieved that you can share?
Yeah, so we haven't paused any of our efforts on technology. In fact, I think our strategy is playing out quite well in that we have partners. So, the automation investment in programming and software is made by NOV. The investments that are being made in the apps are being made by our app partners, and those are multiple partners, including people like Schlumberger, like NOV, like certain universities and certain other companies, like even for lack of an example, Exxon and Shell. So I think that the development work is continuing at the same pace it was even 2 years ago. Our field installations right now are out and running. We have 3 IOCs that have essentially standardized on our alpha automation. We have 1 private equity driller in the U.S. now that has implemented our alpha analytics on all of their rigs. We have a number of rigs there. So we're running alpha analytics on all those rigs. We're making very, very good progress. We'll report fully on our app progress on our Q2 conference call later in July, but we'll tell you that we have a handful of apps now at the fully commercial stage earning routine revenue, and they're functioning well. So we think that as our customers transition back into normal operations, as we're seeing during the month of June and now into July, that more and more focus will be placed on rig efficiency, rig performance, especially as you have a large component of the rigs working right now are working on pure development drilling on multi-well pads where you can compare performance or function step by step, well by well. And that's where technology really shines when you get to drill the same well over and over. So for example, with our Alpha Analytics offering, we have shown a case study in our most recent investor presentation that shows rigs, and I think it's a Duvernay, Carey, is that right?
Yes.
Yeah, where we talk about reducing the drilling time by over 4 days per well on 26-day wells, 28-day wells, using analytics where we measure and monitor every step of the drilling process and make recommendations back to the operator on how to improve minor elements of a drilling program to get optimized drilling performance. So I think we're quickly transitioning alpha analytics from kind of beta into commercial. We have multiple apps that are commercial, and of course our alpha analytics platform is fully, or alpha automation platform is fully commercial. So Aaron, I think the short answer is we're proceeding at pace, on track, and we do think that during this period of low activity but real focus by our customers and performance that we'll shine with our digital offering.
Okay. I know that you mentioned with your most recent quarter you declined to provide specific pricing commentary, which is completely understandable given the trajectory of the rig count and the expectations around the near term. You mentioned that you may have some seasonal return to activity in Canada, maybe a few rigs added back in the U.S. And so I guess I'm wondering, have you meaningfully engaged with customers in recent weeks about rigs going back to work? And without getting into specifics, anecdotally, what can we expect from Precision going forward in terms of pricing strategy for the incremental amount of work that might be out there? And what do you expect we'll see from your peers?
Yeah, really complicated question. There haven't been that many, truly brand new opportunities to get price realization on. And, if you just look at how this business actually works, so even in Canada where we're going back to going from 10 rigs up to 20 rigs, it's likely that those 10 rigs we're adding back are rigs that worked for the same customer last year. So the first dynamic I'll describe is that if a customer has experience with a rig and with a rig crew especially, and that rig did a good job last time, usually their first call is back to us and ask if we can get that rig fired up, if we can crew it with the same crew, the same rig manager, same drillers. And if we can answer yes to all of those questions, then we finally get to the pricing discussion. Obviously, the pricing will be a little bit lower in the summer of 2020 than it was in the summer of 2019. But it's not a market where we have full 500 Canadian rigs competition on every single opportunity. This is a case where it's likely our customer wants that exact rig with that exact crew to come back and do exactly the same thing they did last year. So I would tell you the price gets negotiated back from whatever last year's price was. So it's not a efficient, open, electronic bidding market. It's an ongoing dialogue with our customers. That's the way things progress. Generally, we'll have to show some kind of flexibility, but it won't be material. So short of giving any hard pricing guidance, I just leave you with the comment that it's not full competition, not full efficient commercial bidding, and that we expect that the high-performance super triples we have in Canada that are coming back to work will work at constructive pricing. So I'd guide you to rates in the upper teens, which is in line or in the same range we would have seen last year.
Switching gears to your service rig business, how impactful could the $1.7 billion in federal government funding earmarked for the orphan well cleanup be to Precision, and what sort of timeline can investors expect this to play out?
I think we remain really excited about this program. It's been a little slow getting from application to award. So if you recall on my Q1 conference call, I was talking about how the government very quickly got engaged and opened the process to make applications. And it seemed they were overwhelmed with the tens of thousands of applications they received across the industry. And this includes everybody from surface remediation of locations to people who build fences to those of us who run service rigs. But I think they received tens of thousands of applications. And well, I think they expected this to be big. I think they had no idea how many applications would come in. And that seems to be bogging down the award process. We've had a handful of awards come our direction. The industry's received a handful of awards. They've already opened round 2, and they're talking about a round 3 of application processes. That's in Alberta. We finished making applications in Saskatchewan and BC for their round 1s. There's been, on the whole, there's been very few awards, but it does seem both the federal government and the provinces who are administering this are fully committed to seeing that $1.7 billion deployed between now and end of 2022. I think the well service companies will garner somewhere in the range of 40 to 60% of that funding, and we expect the Precision to earn more than our market share. So you can do the math and determine what that looks like, but I think our guidance of 10 to 20 million of revenue this year remains pretty good, and I think that will increase into 2021 and 2022. It does mean a meaningful amount of work for the well service business, and while it might not return the entire industry to a healthy state, certainly we feel quite good about our free cash flow position as that money begins to flow out.
Kevin and Kerry, time flies with a 20-minute panel, so we're out of time. But